All right, now to our first conversation. As the U.S. Federal Reserve prepares for its upcoming interest rate decision that started yesterday. Markets are closely watching for any signals that could shape global economic conditions. A change in U.S. interest rates, that definitely has a ripple effect worldwide, influencing everything from investment flows to currency values. Well, joining us to unpack this is Dr. Pelumi Olanubi, Executive Director, Kingsgate Advisors Institute, joining me via Zoom. Great to have you on the show. Happy New Year. It's been a while.
Been a while indeed, Ladley. Good afternoon. Good to be here.
Yeah, great to have you. So all eyes are on the U.S. Fed for the first meeting of 2025. What are your expectations? Consensus right now is should be a hold, but I'm sure investors would also be comfortable with a cut. What are you seeing?
All right. It's really an interesting time we had, definitely, with the Trump administration on board and all the policies that began to roll out. It's really an interesting time, and I can see an unprecedented time in the sense of what is happening. And before I even go straight into what the Fed the stance of the Fed, what it might be, let's see some of the policies that have been rolled out in last week that the Trump administration has actually come into play. And three of these policies that really stood out that can actually have impact on the Fed's direction is policies related to tariffs, like you rightly mentioned, related to immigration, and also the one related to tax cuts. For tariff, as everyone is expecting, the Trump administration already signaled that they're going to increase tariff by 10 to 20% for imported commodities into the U.S. across the globe and by 60% from China. What this would mean is it has the potential of leading to an overeating. And overeating simply means when an economy is growing too fast. The reason is because there will be more demand for domestically made produce, and this can lead to have inflationary impact. And we've seen that the U.S. economy, okay, that's on one side. Also on that side, looking at the immigration policies, the administration has also signaled that they are going to, sort of deport as high as 11 million people in the space of 4 years, and that would affect the labor market, put a lot of pressure on the labor market. In the words of Oliver Blanchard, one of the foremost economists in the United States, he said if you discount that and see how that will affect the labor market, it can have an impact leading to increase in unemployment by about 5%. And if you ask me, that's a huge number. And that will also lead to wage increase, which is also inflationary. And the last point that I'm coming from is the issue related to tax relief. This would also have impact the debt, the budget deficits, the budget financing, debt level. And of course, the United States is a very big economy. And generally, analysts and economists are not speculating to enter into what we call sovereign debt. But I mean, anything is possible, right? But looking at it on a more cautious view, we are expecting that, economists generally, analysts, and even markets, they are expecting the Fed to still take a wait-and-see approach in this time. Although we have seen inflation inch a little between November and December, and we can also say that the U.S. economy, to a large extent, has stabilized, looking at unemployment levels, inflation rates, and even growth rate. In fact, the growth rate has proven resilient. So we might still see the Fed taking a cautious approach and see what all these various uncertainties, as most macroeconomists call it, how it pan out and plays into the economy going forward. So right. We might see the Fed still holding rates, seeing how all this pan out.
So even though it could be a hold, I'm sure investors will also be looking out for pointers. Maybe it's a hawkish hold or a dovish hold. At this point, they'll try to read between the lines going forward. But you did mention, deportations, and that brought to my mind, at this point, we're still trying to get more diaspora remittances, going forward. So with the drums of deportation getting louder, what are you seeing for, diaspora remittances, going forward from the U.S. to Nigeria?
I mean, looking at the policies and everything that would happen in terms of, especially when it comes to immigration policies, this can affect some of diasporans that are actually in the United States. I'm not saying Nigerians, but we still have a number of Nigerians that are under risk of being deported. That would affect the inflow. But generally, if you see the interest rate still around the current levels, this will still help in diaspora diaspora inflows and also even portfolio investment beyond diaspora inflows. Also, the fact that the labor market in the United States has been resilient, and we've seen some of these returns, from diaspora coming into the economy, coming out from 30 December and all that. So we can still see this positive sentiment in that sense. We can still see this positive inflow of diaspora remittances, given that we expect that there will still be a caution impact.
And I hope the immigration laws, favor Nigerians, so we can also have a bumper 30 December come 2025. We're still celebrating the one from 2024. But back to the rates now. Let's imagine a hold or maybe a rate cut, later tonight in Nigeria. How do you see this impacting, capital flows into emerging markets like Nigeria?
Right. If I hear you clearly, Larry, you are asking if possibility of rate cuts impact Nigeria, right?
Yes, how that would impact capital flow, into Nigeria.
Oh, okay, great. So if the Fed, as we've seen, in recent time, the rate cuts, the dovish stance of the Fed, it has a positive outlook on the Nigerian economy. Given that Nigeria is a small open market economy, and our interest rate now is becoming more, I would call it more attractive, to foreign investors, and that's why I've been seeing this inflow of rates. But if we don't see a change in the direction of the Fed, given that probably inflation begins to inch upward, and they might want to still hold on to their mandate of price stability and targeting towards the 2% benchmark, that can, of course, lead to strengthening of the dollar, which might affect Naira depreciating further, affecting capital inflow, and even our debt servicing and our debt obligations to the rest of the world. That's not generally a good outlook, given our precarious state already that we are in. But we just hope that as the event pans out, the Fed will still keep their dovish stance. This will help Nigerian Naira, in international markets, and of course eventually we raise bonds or raise any other debt financing. Our obligation will not be higher compared to when the dollar strengthens.
Right, and also we're all bracing for the first meeting for the Central Bank's Monetary Policy Committee. That's for sometime in February. So we're getting the first one already for the U.S. How do you see this impacting, that's a decision today, or influencing Nigeria's central bank's approach to managing inflation and stabilizing the Naira?
Yes, truly. We expect direct, because there's this saying that when the US coughs, when the US sings, the whole world coughs, right? So we expect that there will be this trickle down impact on whatever the direction of the Fed is, by the end of today. For Nigeria, for the NPR, for the MPC, we still expect that, because the CBN, they are clear as to their fight against inflation, reining inflation, and all that. It's a different talks as to talking about major drivers of inflation in Nigeria. But of course, conventional monetary policy will tell you to keep raising interest rates, which is good for the Naira in the sense of attracting portfolio investment, like you said earlier, and as we discussed in the last point, it's good for the Naira. But going forward, if we see a reversal, that's when we can begin to see this reversal also in the trend of portfolio inflow, which will affect the value of the Naira further, and also lead to more inflation through imported inflation and all other direct impacts that this has on an MPC and their monetary stance.
So I guess at this point, if the U.S. Fed holds rates at this meeting or cuts, do you think it helps the Central Bank of Nigeria actually maybe hold in the next meeting?
Yes, it's likely that the Central Bank actually holds in the next meeting. I don't see a reason why the Central Bank would decide to probably cut rates at this point. There is no motivation to cut rates, looking at what inflation numbers are. And of course, also bearing in mind that the CPI rebasing would also have an impact on what the inflation numbers are. Some would argue that it would rather reduce than increase. And of course, that might motivate them to now change their trajectory. So there's a lot to unpack in this actually, in the real sense. And let's see what the outcome will be, given that they are also expecting to see this number to affect their decision. But the word on the street is not so much on what NPR is, or what the monetary policy is, the word on the street is this going to drive down prices? That's the most important thing to consumers in particular right now. And that's what they really want to know, not so much as what the rates are. But of course, generally, the markets are looking at the possibility of moving back to the dovish monetary policy, because we see inflation, by the new numbers coming down, that can be a motivation to start cutting rates in Nigeria. And that will support businesses, that will support economic activities, and probably support growth rates to higher levels.
Right. I guess so much to look out for in 2025, and we've seen projections from different experts and advisors, and most of the time it's been quite optimistic forecasts we're seeing for the Nigerian economy in 2025. Do you think it's going to get easier for the central bank to tame inflation as we get ahead?
I mean, looking at the last couple of months, how that the inflation had actually declined before we now saw the increase again. And inflation has been increasing, but not at the same pace when it was really running high. So this shows that then what the CBN is doing in terms of raising interest rates has a minimal impact on reining inflation. It's almost general knowledge now in Nigeria that we know that the factors driving inflation are more structural in nature than monetary in nature. And that's why you're not seeing that much impact as we expect to see on reining inflation. So as we begin to see more pull or more weight from the physical side of things, and we begin to see more as the naira begins to strengthen, given the low interest rate that we have in developed economy, that would also help in the pass-through effects and all that. So we actually have an optimistic view in that sense, and we hope that inflation rate will keep coming. But I personally don't see that 15%, but we see that downward trajectory. Also, base effect will also have a role to play in the inflation rates that we expect going forward. So it's more optimistic, really. But we are not seeing that. I'm not hoping to see that 15%, but at least inflation should hedge closer to 20%.
All right, definitely. We need more. We need consumers to get some kind of peace, when it comes to most of these prices. But thank you so much, Dr. Pelumi Olanubi, Executive Director, Kingsgate Advisors Institute. Thank you for coming on today.
Thank you for having me, Ladi. Thank you.
All right, we'll take a break now. When we come back, we head to the markets, get a sense of how the expectations, that's for the U.S. Fed meeting, how that's shaking up markets in the global space. That's in a moment. Just stay with us.